In this video, we're going to carry on our discussion of Chapter 5. And in particular, we're going to take, over the next couple of videos, we're going to take a little closer look at something called the classified balance sheet. Now, we've talked about balance sheets up till now, and this idea of a classified balance sheet just says we own a lot of stuff, we owe a lot of stuff, and is it really all kind of the same stuff, or do they belong in sort of different classes? So we'll spend some time looking at that over the next few videos. You need to remember that our overall objective when we were putting together financial information is we want to provide information that's accurate. So we also want to provide information that's clear. And we'd like information that's timely. I don't know whether you've ever had this experience where somebody's trying to give you directions and sometimes they're just a little bit late with that. Turns out late isn't as good as being on time. Anyway, the classified balance sheet basically organizes the assets and liabilities into groups or classes. Okay? And most important subgroups of those really are intended to give us some idea about what's important to the company that's reporting the information, or the business, and also what's important to the person who's actually looking at the information. And we don't always know what's important to them, but whenever you're communicating information, you have to remember the person you're trying to communicate to. That is, what do they want to know? And you do your very best to give them the information that they want to know. So I want you to take a look at this list of assets for this company. Just take a minute, glance down the list. These are all things that the company owns. Now, we could just prepare a list of assets and say on the balance sheet and just list all these assets out and their dollar value and total them up. That was one way to do it. But did anybody notice the time machine? Now, if you actually owned a time machine, don't you think people who are investing in your company would be curious to know that? It might be one of the first things you want to mention as opposed to having it buried in this list of assets. So that's one way, one thing to demonstrate that some things are more important than others and are different. So here's a balance sheet for music components. This is another example out of your textbook. And what we're looking at here is the asset section. And the portion that's highlighted in blue, hopefully that's clear in this video, the top portion of this, is a section called current assets. Now, the use of the word current, this is new, and so I want to explain a little bit about what current actually means. Current assets are assets that are expected to be sold, collected, or used within typically 1 year. Now, the full definition, as you can see here, talks about an operating cycle. There are some businesses that take longer to accomplish their typical transactions than a year. Almost every business you will ever encounter will operate, most of their transaction cycles tend to be fairly short. So we buy merchandise, we sell it to a customer, and then we collect the money and we buy more merchandise. That usually happens pretty quickly for most businesses. So our test typically for current assets is it's either sold or collected or used within 1 year. When you look at this list of current assets, you'll notice cash and merchandise inventory, and you might wonder, well, they're going to be around for a long time. A business always has cash. A business always has inventory. And so, while that's true, you have to remember that that cash we have today and the cash we have a year from now, probably not the same cash. We probably spent the cash we had a year ago and it's been replaced with new cash. Maybe easier to think about that with inventory. The inventory that we had a year ago is hopefully not the same inventory that we have now. So while these things are always on the balance sheet, they're constantly being changed and updated and replaced. And I think this will become clearer when we look at the next section of the balance sheet.